Welcome back. Adani Enterprises is surging after reporting their numbers. The net profit is more than doubled to 1,800 crore, which compares with a number a little less than 900 crore rupees. So 1,888 on the bottom line. The EBITDA too for the company has gone up 98% and the stock has moved up. Reliance Industries too is seeing some buying. On the way down, L&T continues to struggle. I think since the start of the day, or at least in the last 2 hours, it's been the top Nifty loser. Following yesterday's 4% cut, we've got another 2.5% gone in that. Nilesh Shah, MD and CEO of Envision Capital, is now with us on the show. Nilesh, before we get to the budget and the nitty-gritties, Paytm, just the way the RBI has relentlessly come after. I'm not sure if that's the right way to put it, but it's just that it's been, a lot of bad news for Paytm, and now particularly this latest one on Payments Bank. How would you read it?
Yeah, so I think the series of bad news just doesn't seem to be stopping for Paytm. I think the regulatory challenges probably started maybe more than a year back, and it's been kind of being ongoing there very periodically. And I think this time it's probably the most damning one. I wouldn't say it's an existential crisis, but it surely is a very big challenge. And it could take some time for them to kind of overcome this challenge.
So if someone holds Paytm shares, if there is an possibility of an existential crisis, would you recommend selling out if they get a chance?
See, I think the stock price is surely going to head a lot lower, undoubtedly. And the reason for that is because these are growth stocks. They're not even growth stocks. Expectation are these are hyper growth stocks. I think right now hyper growth is ruled out. Growth is ruled out for the foreseeable future. You're not talking about whether you are in a position to even hold your base, hold your core. I think that's really where the big challenge or the big vulnerability is. So I think the case to own it for now doesn't seem to be there. And I think it's the first day of the bad news for them. This is something which could linger for some more time. And in this kind of a situation, even if it takes, say, another month for them to sort it out, a month can be a very long period of time.
3:30, by the way, there is a conference call.
Yes.
And we'll hear from maybe Vijay Sharma, Madhur, etc. will be on the call and they will take questions. Wonder if that can do anything to, because the RBI circular is so damning in that sense,
yes,
right? I don't know how much they can do. But instances like this, I mean, I'm going off a tangent also bring up the old topic of circuits, right? But there's no exit. I mean, if you, as Rima was saying, if you own shares, you just wait and try at 9:15 in the morning. And but as you said, it perhaps could head a lot lower.
Yeah, I think, that's a challenge. And I think unless a stock is not in the futures and options stock thing, I mean, once it hits the circuit, lower circuit, you obviously don't have the exit. And that's the challenge. Maybe if this situation happened maybe a year or two later when it was part of F&O or maybe part of an index, then this situation would not have been there. But that's what it is. And I think this whole circuit system, whether we like it or not, it's been working well for our capital markets, our equity markets. I've seen this for the last 10, 20 years. And I think, it has its positive, it has its own set of challenges.
Nilesh, okay, let's talk about the one set of stocks that's cooling off finally a little bit. And I'm talking about PSUs now. I don't know what to call it. I mean, after a 200% rally, you get a 2%, 3% cool off. How would you approach this part of the market, considering that this interim budget is out of the way, but then you have July, and then you need to see what comes forward in terms of more policy continuity. Even today, there was some mention on railways, but no major capex numbers thrown around. What would you do with PSUs now?
So I think for now, the valuations surely look challenging. They definitely look overstretched. Okay, leave aside the PSU banks because this budget is done a lot of good to them. The whole path to fiscal consolidation, a significantly lower fiscal deficit estimate for next year, obviously is cooling off bond yields and driving up bond prices, which is good for PSU banks. But outside of PSU banks, I think most PSUs right now look very richly valued. They have gone up quite significantly. They're getting priced in like growth stocks, and they no longer represent the kind of value which they represented 2 or 3 years ago. So I clearly think for now, while there might be a structural change to them and they might end up becoming much bigger enterprises in the next 5 to 10 years, but I think a cool-off is warranted in them. I'm not saying a very severe sell-off, but a cool-off is surely warranted, and maybe wait for better or lower prices to get into them.
Just on that, a follow-up. Now, once the election is out of the way, one is waiting to see if this, divestment really starts taking off. And Prashant was also discussing this with our earlier guest, that this is as good a time as ever, right? And I don't know why they waited, but they have, maybe elections. As and when those OFSs start hitting the market, could it really puncture the whole PSU move? I mean, is that a risk that we're kind of walking towards? Or do you think the market will treat the divestment and digest it quite well, actually?
Yeah, I think it will treat it well. See, I clearly think right now, I mean, 2 years back or 3 years back, some of these OFSs were being looked upon as basically capital raising exercises. Today, the government's finances are not as constrained, and so they are not getting perceived as capital raising exercises. If at all, mutual funds or some of the institutional investors who are getting fresh liquidity, they're looking at this as an opportunity to be able to park that liquidity and buy into them. So the whole negative narrative has now become actually a positive narrative. And a more free float, which means the chances of getting into market indices, having a higher weight. So that's now so that's how the narrative is now playing out.
OFS is no longer bad.
It's no longer a bad word. It's no longer a bad word.
You know, it's a stark contrast to what we should see a few years back, right? And
Yes.
OFS is announced, you have LIC coming and picking up bulk of that,
Yes.
and after some time the stock starts trickling down.
Yeah.
Case in point being in NHPC. You know, they didn't, government took some money off the table. In the last 10 days or so, the stock is up, what, 15-20% or even more than that. So the entire perception actually has changed. And also, if you look at, you know, companies like Concord, IDBI, yes, we're waiting for the divestment to take place, but the stock price is still at the 52-week high. That's tell you the kind of interest in some of these names. Just thought we'll put that point on board.
Yeah. And one more thing, I think is also some of these PSUs are in sectors which have become the flavor of the season. So 2, 3, 4 years back, nobody wanted to buy energy stocks. Renewables was pretty much unheard of.
Yeah.
Today, when you talk of names like NHPC or some of the other PSUs, they are part of emerging themes. Whether you call this as energy transition or renewables or any of the other, they've become clearly the flavor of the season, and that's also what is attracting investor interest into them. And they seem to be meaningful players. I mean, whether you look at NTPC and you speak to most investors, they really don't talk about it as now a thermal energy company. They are talking more about their initiatives of investing in renewables, the green energy, and all of that. Versus that 2, 3 years back,
Yes.
they were supposed to be, you know, guys who are probably spoiling the environment.
Indeed, and I pity those who said touch me not, you know, for some of these companies,
Yeah.
because you missed on the biggest rally possibly. Nilesh, just hold that thought. Pre-2010.
No, it is a real pain. So in that sense, it's a great move, right? It's a big irritant. It causes anxiety and all kinds of things. So
No,
withdrawing
absolutely.
some of this,
Yeah,
really
yeah,
good.
and absolutely. I mean, it's pretty much in line with the ease of living kind of thing. So I think it's good. It's good that at least some of these small old irritants, which are large in number, I think are just kind of eliminated. I think it's a big positive.
I just wanted to get your thoughts in again on this capex number. So one of the big drivers for the PSU stocks was this large capex spend of 35% last year. And that drove very strong order wins. The order book was swelling, and therefore the market was giving that expected earnings multiple, earnings growth and multiple going ahead. Now, if that growth rate of spend is going to come down from 35% to 11%, will that not slow down the kind of order wins we're going to see for some of these, PSU companies, and therefore will it hurt the earnings expectations?
So I think, Rima, it's got a bit to do with the change in reality. 3, 4 years back, nobody wanted to actually invest in infrastructure or lend to infrastructure projects. That was pretty much a no-go area, and therefore, clearly it had to be the government which had to step in as the anchor investor, as the anchor lender, and come in and therefore allocate more money from the budget to the sector. In the last 3 to 4 years, infrastructure now has become no longer the kind of no-go area, and now private capital is willing to come in, either through equity investment or through lending. Also, you're going to see foreign capital come in as the Indian bonds become part of the indices, all of that. So now probably the government is trying to pass on the baton to the private sector, saying is that, look, you guys can now come in and lend or invest. And therefore, the need for government to kind of now incrementally allocate that much capital may not be there. Keep in mind, 11% still is a very large number on a base which has probably gone more than 2x over the last 4 years. And secondly, as a percentage of GDP, that number still is 3.4% versus 3.3%. That 3.4% is like at a historic high. I mean, many years back, that number was sub 2%. So these numbers are huge. So to that extent, I think it's still kind of, it's par for the course.
You know, on the point of capex, sorry, just to come in over here, since Rima asked that question, we had Mr. Amitabh Kant on the show just a while back, and he was, constantly making that point that it's time for the crowding in of the private sector.
Yes.
Haven't seen too much sign of that as yet. Your thoughts on this, Nilesh?
So private capex, yes, it's still not yet picking up. Though, of course, the government had reduced the tax rate for manufacturing companies maybe 5 years back so that they could basically be incentivized to come in and expand capacity and set up new units. That has probably not happened to the extent that it may have been desired. But that's because the capacity utilization was trending below long-term averages. Now that is trending above long-term averages. So I think probably, again, it might just be a matter of a few months before the private sector comes in with its own share of capex. But otherwise, still that doesn't happen. I still think the economy will have to rest on this pillar of public sector capex.
Okay, all right, Nilesh, we appreciate you coming down to the studio. Thanks so much for joining in this afternoon.
Thank you.
Looking forward to chatting up with you rather soon. Well, for the time being, let's... Well, thanks so much for tuning in to CNBC TV18. Make sure you follow us and stay updated on all our social media platforms.